Canada's inflation rate just jumped again. And immediately, the big question becomes this: does this mean interest rates are going higher again? Does this mean mortgage rates are going to stay higher for longer? And what does it mean if you live in BC and you're watching the real estate market right now? Should you buy? Should you sell? Should you wait? Because here's the part most people will miss. Yes, the headline inflation moved up to 2.8% in April. But when you look underneath the headlines, the story is not as simple as inflation is back. The big part of this increase is coming from the gasoline and energy prices. Core inflation, which is what the Bank of Canada watches more closely, is actually much calmer. So, in this video, I'm going to break down what just happened, what it means for interest rates, and how BC residents should think about real estate market over the next few months. Hi, I'm Roshan Victor. I'm a local real estate professional serving the Fraser Valley and the Greater Vancouver area. And on this channel, I talk about real estate, market trends, interest rates, affordability, and the practical decisions people need to make in today's market. And today, the CPI report is important because inflation is one of the biggest factors that influences the Bank of Canada. And the Bank of Canada influences borrowing cost, and borrowing cost directly affects real estate. So let's get into the numbers first. The latest inflation report for April 2026 shows that Canada's consumer price index rose to 2.8% year over year. That is up from 2.4% in March. So, on the surface, inflation looks like it's heating up again. But when you break it down, the biggest driver is energy, especially gasoline. Gasoline prices have been pushed higher because of the global oil supply concerns tied to the conflict in the Middle East. That means the inflation number is being pulled up by something that is very visible to consumers. Because every time you go to the gas station, you feel the effects immediately. But here is the important part. When you remove gasoline from the CPI numbers, the inflation actually slowed to 2%. That matters because if inflation is rising because of energy, that is very different from inflation rising because of the entire economy is overheating. Food inflation also cooled slightly, moving from 4% in March to 3.5% in April. In BC, consumer prices were up 2.5% year over year, which is lower than the national number. And the Bank of Canada preferred core inflation measures, CPI median and CPI-trim, were around 2% to 2.1%. So the headline numbers say inflation is up, but the deeper numbers say underlying inflation is still close to the Bank of Canada's 2% target. That is the key takeaway. Now let's talk about the interest rates. Bank of Canada held its policy rates at 2.25% on April 29, 2026. That was the fourth consecutive hold. The next rate announcement is scheduled for 10th of June. So the big question, will this CPI report force the Bank of Canada to raise rates again? At this point, probably not immediately. And the reason is simple. The Bank of Canada does not usually react aggressively to 1 month of higher inflation if that inflation is mainly caused by gasoline or energy shocks. They care more about whether inflation is spreading across the broad economy. Are wages accelerating too fast? Are service prices moving higher? Are rents, food, insurance, construction costs, and consumer spendings all creating a new inflation cycle? That is why they are watching. And according to the data, core inflation is not showing that kind of serious reacceleration yet. So, my view is this: the CPI report likely supports a hold and wait position from the Bank of Canada's perspective. It does not scream rate cuts. It does not it does not clearly justify an immediate rate hike. For BC real estate, that means we should not expect borrowing costs to suddenly become dramatically cheaper overnight. But at the same time, this report does not necessarily mean mortgage rates are about to explode higher either. So now here is where it becomes important for someone watching the real estate market. There are two different conversations happening at the same time. One is the Bank of Canada policy rate that affects variable rate mortgages, line of credit, and borrowing costs, tied more directly to the prime rate. The second is the bond market that affects fixed mortgage rate. So even if the Bank of Canada holds the rate steady, fixed mortgage rates can still move up or down depending on the bond yield, inflation expectations, and global uncertainty. This is where people need to be careful. If you are waiting for the Bank of Canada to cut rates before making a real estate decision, you need to understand that rate cuts are not guaranteed just because the housing market feels slow. Bank of Canada has to balance two things here. On one side, they have inflation. On the other side, they have a soft economy, affordability pressures, and a housing market where many people are already stretched. So for now, we may be entering a period where rate stays relatively stable but not dramatically lower. And that creates a very specific real estate environment. It is not a crazy low rate market. It is not a panic high rate market. It is a selective market. People are cautious. Affordability still matters. Monthly payments still matter. And the best decision usually comes from understanding the numbers before making a move. In my opinion, this CPI report is a reminder that the real estate market is not just driven by home prices. It is not driven by affordability, and affordability is affected by many things at the same time: interest rates, mortgage payments, insurance, property taxes, strata fees, fuel costs, groceries, utilities, renovation costs, and overall household confidence. So, even if home prices come down slightly in some areas, that does not automatically mean home prices become affordable. So, even if home prices come down slightly in some areas, that does not automatically mean homes become affordable. If borrowing costs remain elevated and the cost of living remains high, people still have to be very careful with their numbers. And this is where I think many people make mistakes. They look at one headline and make a big decision. They see inflation up and think the market is going to crash. Or they see core inflation is down and think rates are going to drop and prices will jump up again. Rates are going to drop and prices will jump up again. But the real estate market is usually more complicated than that. Real estate does not move because of one data point. It moves because the combination of interest rates, inventory, affordability, employment, immigration, consumer confidence, government policies, local supply, all of these have to play in tandem for one move to happen. And in BC, especially the Fraser Valley and Greater Vancouver real estate is very localized. What is happening in downtown Vancouver condos may not be the same as what is happening in Surrey condo market. What is happening in the Langley detached homes may not be the same of what is happening in the Burnaby area. What is happening in the Langley detached homes may not be the same as what's happening in Burnaby's detached market. So instead of trying to predict the entire Canadian housing market from one inflation report, the better approach is to understand your local market, whether you're buying a condo, townhouse, duplex, half duplex, row house, or a detached home. Look at the type of the property, look at the location, check the last 3 months sales data, look at how much supply you have, look at the number of days on the market, look at the number of price reductions that have happened over that time. More importantly, look at what your monthly payment will look like, not just the purchase price. Because at the end of the day, real estate is not just about whether the price is up or down, it's about whether the numbers make sense. The biggest message from this CPI report is that we still are in a cautious environment. Inflation is not completely gone. Interest rates may not drop as quickly as people hoped, and affordability is still a major issue for many, many households in BC. And qualification is also a major issue. That does not mean people should panic, but it also means people should not ignore the risk. The ultra low interest rate market is gone. That was the market where people could buy almost anything and expect prices to rise quickly, and that market is gone. Today's market requires more discipline. You need to know your numbers, you need to understand your cash flow, You need to understand the real monthly cost of owning a property. You need to understand how much buffer you have to cover your expenses. You need to understand how much buffer you have if expenses go up. And you need to understand whether the property still makes sense if rates stay where they are or go higher. This is especially important in BC because the cost of ownership is not just the mortgage, it is a plethora of things. That's why it's important to look at the full cost of ownership before you make your decisions. So, if you're watching the BC real estate market right now, here is my practical advice. Do not make sense based on headlines alone. A headline can tell you inflation is up, but it may not tell you why inflation is up. The headline can tell you rates may stay higher, but it may not tell you how that affects your specific situation. The better approach is to slow down and look at the full picture. Ask yourself, what is really happening in the local market? Is the inventory rising or falling? Are the properties selling quickly or sitting longer? Are sellers reducing prices? Are buyers negotiating more? Are monthly payments for me manageable? And do I have enough financial buffer? And does the decision still make sense if the market moves slower than expected? That is the kind of thinking this market requires. Because your next phase in real estate in BC may not be dramatic. It may not be a crash or it may not be a boom. It may be a slow, more selective market where good decision matters more than ever. And in that kind of market, patience is valuable, preparation is valuable, good advice is valuable, and understanding the numbers is extremely valuable. So here's the bottom line. The inflation numbers in Canada moved up to 2.8% in April, but this was largely driven by gasoline and energy prices. Core inflation is still close to the Bank of Canada target. That means the probability of Bank of Canada holding on to the rates where they are is higher. So, in the short term, there is no need to panic, no need for assumptions. Things are going to be the way they are. It's going to be a slow road to recovery. And if you're thinking about real estate in the Fraser Valley or Greater Vancouver, reach out. There's a link in my description below to book a one on one consult with me. And if you haven't done so just as yet, hit the subscribe button and click the bell icon so you can be updated on every single video that I put out. And see you in the next video.